But what matters is when do you buy them and at what price. And to do that, you have to, the prices are set low because everybody else is pessimistic. You should be optimistic. The market is set high and dangerous. When everybody else is optimistic, you should be pessimistic. But it takes, obviously, emotional control to be able to do that.
It's tough. It's
Yeah.
the minority. The ability to be a liquidity provider at the bottom of a cycle, does that link to this notion of emotional intelligence that you're talking about?
Well, I would say emotional control. Look, if you think about cycles, and this is there's a lot about this in the book, and that's why I recommend that everybody buy several copies. But if you think about the cycle, the market cycle, let's say, that goes this way, what's happening? So we're in one of these periods, and the economic news is good. Everything on MSNBC is favorable. The newspapers only report the good news. Most stories can be given a positive spin. The companies are performing and they're generally exceeding expectations. The stock prices are rising. The rising stock prices are making people feel good. People are turning more optimistic. Their fears are abating. Their eagerness is rising, and they're buying. And people tend to buy more when prices go higher. And then, of course, the reverse is true on the other side. The news is bad. People get depressed. They've lost money. They feel terrible, and they start to sell. So people tend to buy a lot here and sell a lot here. Now, unless I'm mistaken, they got it wrong. You're supposed to buy here and sell here, and not buy here and sell here. Buy low, sell high. It's very easy dictum. So why do they do the opposite? Why do people buy here and sell here? And the answer is, I think we can lump the explanation under the heading of emotion. And you mentioned Seth Klarman and Stan Druckenmiller. I mean, these are two people that have been here in this series. And I think one of the things that they have in common among, they're very different people, but they're both brilliant. But one of the things they both have in common is they're not emotional. And I say in my book that not being very emotional is very useful in the investing world. There are worlds in which it's not such a good thing, like in marriage. Right? Lack of emotionality does not endear us to our spouses. But the truth of the matter is, it's very helpful to either be unemotional or have the ability to control your emotions. You have to, when you make the really big money in this world by unhooking from the market when it gets up here, and everybody's happy, and nobody could think of anything that could ever go wrong, and everybody thinks that trees are going to grow to the sky, and so you sell up here, and then the market collapses, and when you get down here, nobody can think of anything that could ever go right again, and every stock price is devoid of any optimism at all, and that's a great time to buy. But to be that, you have to be a contrarian, and you have to be able to diverge from the crowd. Now, if you think about it, everybody receives the same inputs. We read the same newspaper. The economic news is the same for all of us. The corporate news is the same for all of us. The TV says the same thing to all of us. Some of us see the news and the prices as a buy signal, and just when most people see the news and the prices as a sell signal, and vice versa. And you want to be in the minority. Back in the early 70s, somebody gave me a great gift and told me about the 3 stages of a bull market. The first stage, when only a few unusually perceptive people believe to understand that there could be some improvement. The second stage, when most people accept that improvement is actually taking place. And the third stage, when everybody and his brother believes that things can only get better forever. You make a lot of money if you buy in the first stage. You lose a lot of money if you buy in the last stage. You buy the same things, but what matters is when do you buy them and at what price. And to do that, you have to, the prices are set low because everybody else is pessimistic. you should be optimistic. The market is set high and dangerous. When everybody else is optimistic, you should be pessimistic. But it takes, obviously, emotional control to be able to do that.
It's tough. It's
Yeah.
the minority.
You prompted me to think a little bit about your notion of being aggressive or defensive in different kinds of market situations. You talk about that as something that governs a lot of how. Could you explain a little bit?
Well, I really think that the most important single decision for what I call the medium term in investing is whether it to be more aggressive or more defensive at a point in time. Now, I'm not talking about the short term, like the next day, week, or month. And I'm not talking about the long term, like 30 years, when you can ignore the interim fluctuations. I'm talking about 2, 3, 5 years. If you're positioning your portfolio today for the next 3 years, I think the most important question is whether it should be an aggressive portfolio or a defensive portfolio. And it's not stocks versus bonds, high quality versus low quality, growth stocks versus value stocks, US stocks versus foreign stocks, developed world stocks versus emerging stocks, large companies versus small. The most important question is offense or defense. If you have an aggressive portfolio in a period when defense was called for, you'll get chewed up. And it doesn't matter how you answered all those other questions. And if you have an aggressive portfolio at a time when it turns out that aggressiveness was propitious, it doesn't matter how you answer those questions either. You'll be successful. So I really believe that that's the key. Let me talk about it in another direction now. I believe that every investor, myself included, every day faces 2 risks. I call them the twin risks. What are they? The first one is obvious. It's the risk of losing money. The second one is a little more subtle. It's the risk of missing opportunities. And we have to confront these every day. Now, if you say to me, I want to be absolutely sure that I don't lose any money, then I'll say, okay, we'll put you all in T-bills. You can't lose any money, but you miss every opportunity. If you say, I want to be 100% sure I don't miss any of the opportunities, then I say, okay, no T-bills for you. We'll put you all in risk assets, and you will be 100% exposed to the risk of losing money. So you can eliminate one, but it puts you firmly in the crosshairs of the other, or you can compromise on the 2. And most people, what do they say? Well, I don't want, I don't want to lose any money, but on the other hand, I don't want to miss all the opportunities. So I'm going to do some of each. I'm going to balance aggressiveness and defensiveness. I'm going to balance worrying about avoiding losing money and worrying about missing opportunities. And that's the right thing to do. All one or all the other makes absolutely no sense. Okay, manage the 2 risks. Balance them. In what proportion? That's the next question. So the way I think about this proposition, so in July of 17, I wrote a memo advising some caution, and some guy on TV says, that's it, Howard Marks says it's time to get out. And when I ran into him the next time, I said there's only 2 things I would never say. Get out, and it's time. Because I am never that certain, and the investment world does not permit that level of uncertainty. It's not black or white. And when you go on the TV shows, as I do sometimes, they want you to say buy or sell, in or out. But it's not black or white. It's how you balance. Mm-hmm. And the way I think about it is there's a speedometer, like on the dashboard of your car, and it goes from 0 to 100. And 0 is all cash. And 100 is fully invested in risky securities and perhaps using margin or leverage. And the question is, where should you be in between? Now, if you want to invest, and most people say, I want to make some money, so I'm going to invest. And they try to think about whether they should buy Apple or Amazon. But they missed a step. The first step that everybody who considers investing should take is to say, from 0 to 100, who am I? Given my age, my financial position, my income, my requirements, my dependents, my psyche, where should I normally be? If you're young, if you have a great career ahead, if you're making more money than you need, if you have no dependents, and if you make a mistake in investing, you have decades more to make it right, then you can be an 80 or a 90. If you're approaching retirement and you have a dependent spouse and you're not going to be earning your income anymore from your job, and if you are concerned about your ability to live with the emotional impact of fluctuations, then you might be a 30. So every person should perform serious introspection and figure out where they should be. And the emotional content is extremely important, because the one thing you can't do in investing is you can't do the right thing if you can't stand the pain. Mm-hmm. And everything that happens emotionally conspires to make us make mistakes. Most people get excited the better things go. They feel better about stocks the higher the prices. They tend to buy more when the prices are at high levels. And then when it turns down, they get depressed and they get sad and they rue the day they ever bought a stock, and they tend to sell at low prices. That's what most people do. How can we tell that that's what most people do? Because stocks go up, and when they get too high, then they come down. And most people are buying up here, that's what puts them up here, and they're selling down here, that's what puts them down here. So emotion works to our destruction. You must figure out whether you can live with the emotional ups and downs, and if you can't, there are things you can do. You can turn your money over to other people to manage. There are ways to put your investing on autopilot. Anyway, background. So there's a speedometer. It goes from 0 to 100. Each one in the audience should figure out normally where they should be. And let's say I conclude that I'm a 75. Next question. Where should I be today? Should my portfolio be riskier than my normal portfolio because I think there are great times ahead and prices are low and psychology is depressed and I think it's a propitious time to add risk? Or should I have less risk than normal because I think prices are high and optimism is every place and euphoria and the pendulum of psychology is probably going to swing back towards the midpoint? So I think it's extremely important to figure out where we are in the cycle and consequently where we should be positioning our portfolio risk-wise relative to our normal position.
Boy, that sounds like a lot of discipline, Howard.
Well,
ask most people to do. I mean, they want to follow the herd, don't they?
Well, they want to follow the herd, but the herd is usually wrong.
Yeah.
And in investing, there's something called contrarian behavior, and all the great investors are by definition contrarian. In order to have a great investment result, what do you have to do? You have to buy when everybody else is selling and prices are low. You have to get out when everybody's buying and prices are high. You have to avoid the things that everybody loves and has bid up, and you have to buy the things that everybody hates and have permitted to drop like a stone. You have to do the opposite. But it's not easy. And Dave Swenson, who runs the endowment at Yale, which is, I think, the best performing endowment in the country over the last 33 years that he's been there, says in his book that superior investing requires the adoption of uncomfortably idiosyncratic positions. And those two words are fabulous. Because if you want to be a superior investor, even if you want to avoid these horrible mistakes that I described, by definition, you must invest differently from the herd. You must invest idiosyncratically. But by definition, idiosyncratic positions are uncomfortable. Why? Because the market's going like this, every stock is getting more valuable every day, you say it's overpriced, you get out, it continues higher. Everybody else is making money, telling you what an idiot you were to get out. And you know, there's a book about bubbles and crashes by Charles Kindleberger. He says there is nothing worse for your equilibrium than to watch a friend get rich. That's human nature. And so, and by the way, so you get out of something, nobody ever identified an asset that was overpriced and got out only to see it go down the next day. Overpriced assets, general rule, overpriced assets become more overpriced. And you have to be able to live with that. And it's uncomfortable. And there's an old saying in our business that being too far ahead of your time is indistinguishable from being wrong. But you have to live with that because there is no alternative.
So Howard, let's step back and talk for a moment about the most important thing. In that book, you listed a number of important things.
Yeah.
But Market Cycles is the only book you've written from that list.
Yes.
Why Market Cycles?
Well, I think that, the book says the most important thing. There are 21 chapters, and each one starts off by saying the most important thing is, and then it's a different thing. Because in investing, there is no one important thing. There is, maybe you might argue, there's no, what was it, Lombardi says, winning is not the...
Let's see how many people in the audience even know who Vince Lombardi is.
Vince Lombardi, anybody?
Okay, well, we have at least a third.
He said, winning is not everything, it's the only thing. And as I say in the book, I'm not exactly sure what that means. But I think that the two most important topics in investing are risk and cycles. And they're connected because where you are in the cycle determines your risk for the intermediate term. Now, the reason I think risk is so important is because I think that the distinguishing mark between a great investor and a not great investor is not merely how good the return was, but how much risk they took to get it. If you can lever up an S&P. Nowadays with derivatives or ETFs, you can buy an ETF that goes up or down 4 times as much as the S&P, or maybe 8 times. And if you buy that and you go into a very positive period in the market, you'll have an astronomical return, but it doesn't mean you're a great investor. Because they'll say, look at that guy. He went up 8 times as much as the S&P. Well, guess what? If it had been a down period, he would have gone down 8 times as much as the S&P. He added no value, who is not a good investor. I think that an exceptional investor is someone who has a good return disproportionate to the risk borne. A good return with the risk under control. So I actually do think that risk is the most important thing. And in the book, there are 21 chapters, and there are 3 on risk. Understanding risk, recognizing risk, and controlling risk. But I also think that where we are in the cycle is enormously influential in terms of how much risk you'll bear. And I'm not crazy about the title of this book. I was encouraged to do that by my publisher because they thought if we said Mastering the Market Cycle, we'll sell more books because everybody will figure out that they'll get rich. But I like the subtitle, and the subtitle is Getting the Odds on Your Side. We don't know what the future holds. I am not a believer in forecasts. In fact, Michael started off with a quote from Galbraith. My other favorite quote from Galbraith is that there are 2 kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I believe that very strongly, and I am firmly in the first camp. I don't know what the future is going to bring. And I don't think anybody does. The future can only be thought of intelligently as a probability distribution. what is the range of things that may happen, which is the most likely, which other ones are probable, and which ones are unlikely. And we describe, a great quote from Elroy Dimson at the London Business School, more risk means more things can happen than will happen. That's the source of risk, is that the future is uncertain. And if the future could be predicted, in theory, there would be no risk.
You know, in your book, when you talk about mastering the cycles, which is this ability to recognize patterns and know when they come back, which you develop over years of understanding, you did mention that it's important to know your positioning.
Yeah.
That is, to have a good sense of sort of where you're at. Could you talk a little bit about how you think about that?
Sure. Well, first of all, what everybody wants to know is what's going to happen tomorrow. Market was down 800 yesterday, 550 today. What's going to happen tomorrow? What's going to happen over the next year, over the next 3 years? And the answer is nobody knows. And I don't believe in forecasts. Another one of my heroes, John Kenneth Galbraith, said we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I am firmly in the first camp. I don't know what's going to happen in the future. And what I say is we never know where we're going, but we sure as hell ought to know where we are. It may be challenging to predict the future. It shouldn't be that hard to predict the present. And if we can, if we can think in terms of a normal trend line, perhaps for the market, or a level which represents fair value, and then the fact that the market oscillates around it, then clearly it's very important to know where in that oscillating pattern we are. Because if this is fair value, and we're here, then clearly the expected value, the expected performance from here should be lower than the historic average. The historic average was compiled by buying at prices all along the cycle, but clearly if we're at the peak of a cycle, our prospective return is lower than historically it has been on average, and it's harder to make money than it historically has been, and easier to lose money. Whereas if we're buying here when prices are depressed, then the expected value is higher than the historic average, and it's easier to make money and harder to lose. So it makes a profound difference, and I think it's extremely important that we figure it out. We don't know where we're going, but where we are has implications for where we're probably going eventually. Now, the word eventually is very important, because if I tell you that the market is high in its cycle and is overpriced, one of the most important things for you to realize is that overpriced and going down tomorrow are not synonymous. And so if you think about the market fluctuating this way around fair value, then when it goes above the line, it's overpriced. When it goes higher, it's more overpriced. Higher, more overpriced. And markets which are overpriced tend to become more overpriced before eventually they reach a top and turn down. So it's a big mistake to think that overpriced and going down tomorrow are synonymous. You can say that's overpriced, you can sell it, and it goes up another 20%. You feel like an idiot, and you get fired by half your clients, but that doesn't mean that it was wrong. And I'm straying a little bit from your question.
No, but that's okay. I'll bring it back to a couple of things.
But you know, all you can do in this world is do what's right. You can't necessarily do what's going to work tomorrow. When I started at Wharton 55 years ago this month, and the first lesson I remember learning at Wharton was that you can't tell the quality of a decision from the outcome. Now, this is counterintuitive and, in fact, perplexing. And most people who are not analytical or insightful would say, well, of course you can. Good decisions work, bad decisions fail. But the truth of the matter is that in the world, there are a lot of things that are unpredictable and random, and as a result, good decisions fail all the time, and bad decisions succeed all the time. And we all know people, we say, oh, he was right for the wrong reason, or he was lucky, or he was unlucky. And so you can't think of the world as a place where good decision, good outcome. Bad decision, bad outcome. It doesn't work that way. You know, Richard Feynman, the physicist, said that physics would be much harder if electrons had feelings. And the truth is that markets, there is no such thing as a market. There's no place. It might be a building or it might be virtual. What is a market? It's a bunch of people who buy and sell. And those people do have feelings. And so they don't always act in a way which is predictable. They don't always act in a way which is right. Sometimes they do things which are counterintuitive. To predict the movement of the market, then, at the time when people do things which are unpredictable, you have to be able to predict it, which by definition you can't.
Which is a good reason why we have the business judgment rule.
Yes.
Imagine putting these
That's
people
right.
together. So the process and kind of how you came about it is really speaks to the quality, but the outcome, you could be wrong because of a whole bunch of other things.
Sure.
We see it all the time here.
Well, if I can take one more minute, the next to last, I will.
Yes.
The next to last paragraph in the book quotes from Peter Bernstein, who was a great market observer and sage. And he said, the future is not ours to know, but it helps to know that being wrong is inevitable and normal, not some terrible tragedy, not some awful failing in reasoning, not even bad luck in most instances. Being wrong comes with the franchise of an activity whose outcome depends on an unknown future. Now, you know, imagine if you were a baseball player. You have 5 trips to the plate and you make out on 3 of them and you kill yourself. The point is that very few, you know, Ted Williams got 2 hits on every 5 trips, and he was the best in history. Nobody gets sick 3 out of 5 or 4 out of 5, and it's the same in investing. None of us get it right all the time. All we can do is have a better batting average than others. If you have a better batting average, then you'll be a superior investor.
Well, in baseball, if you bat .333, it's Hall of Fame.
You're exactly.
So maybe the investors out there ought to think about, you lose 7, don't worry about it because you'll win 3, right?
Is your view that value investing as a category has A, gone out of style, and B, is it riskier or safer than growth investing?
No, I think that value investing is, you know, first of all, the distinction is a little bit artificial. And it's not, and anyway, it's certainly not black-white. Value investing means making investments based on the current characteristics and attributes and assets and values of the company. And growth investing means investing primarily on the basis of the potential and what it might look like 10 years from now, 5 years from now, 20 years from now. Clearly, it is, everything else being equal, it's less risky to invest on the basis of things that exist today than on the basis of things that might exist in 10 years. There's no question about that. However, I say it's not that clear-cut because the value of the things that exist today is largely attributable to what they'll produce, especially in terms of cash flow, over the next X years. So you can't divorce yourself from thinking about the future. So people say, well, value investing is about the present and growth investing about the future. But you can't divest yourself of thinking about the future, because let's say you want to buy a factory that makes XYZ. You don't buy it for the bricks and the steel and the real estate. You buy it for its ability to produce a product that makes money. So there have to be some judgments about the future irregardless. The question really is the relative weighting. So you buy, look, back in the 99 period, people bought stocks of companies that had an idea, no product, no clients, no revenues, no profits. That was an extreme case, and most of those worked out very badly. But clearly, the people who invested in eBay or Facebook or some of these have made a lot of money. And now one of my favorite quote from a fortune cookie. I actually found a fortune cookie one time that said, "The cautious seldom err or write great poetry." and so for the most part, the value investor thinks of himself as not erring so much, and the growth investor as writing great poetry.
Okay, so Seth got the title right in some sense.
Yeah,
Okay,
I think that's right.
Okay.
Risk, it's another area that you really cover in the book. And you've devoted it into three parts, kind of understanding it, recognizing it, and controlling it. Let's walk through how you look at risk and how investors, as you've pointed out a couple times here, commonly misjudge risk.
Well, number one, most people equate risk with low quality assets and safety with high quality assets. And they still do. I mentioned the Nifty 50. High quality, people thought, there's an old saying, you can't get hurt buying IBM. And we documented you lost 80 to 90% of your money. On the other hand, what about low quality? Is that a source of risk? When I got started in high yield bonds back in '78, I looked up in Moody's, what does it mean to be single B? And Moody's defined a single B bond as follows, quote, fails to possess the characteristics of a desirable investment. In other words, low quality asset can't be a good investment. Well, is there no price at which a low quality asset becomes a good investment? If we went out after this session to the parking lot and I said to you, I'd like to sell you my car, would you like to buy it? And let's say you like my car and you have money and you need a car. Hopefully there's one question you would ask me before saying yes, and that's, what's the price? And here Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? And so this is the kind of herd error that you can take advantage of. So risk is not quality. And, most people believe that as something is rising in price, that means that people think better of it, it's less risky. Well, I think that when something rises in price, it becomes more risky. Most people believe that the things that everybody think are risky are risky. I think the things that everybody thinks are risky are safe because their aversion to it forces down the price to the point where it is safe and potentially lucrative. What is the riskiest thing in the world is the belief that there's no risk. Risk is perverse. That's the important thing that's what the chapter in the book talks about, it's the perversity of risk. And it's the belief, like in '07, the belief that there was no risk is what made the world risky. And in late '08, after Lehman Brothers melted down, the belief that there was no potential future is what created a great potential future.
And I think to follow up on Howard said here, the rating agencies keep the same rating on a security, whether it's 100 or 25. It might be a AAA at 25. It might be a single A at 50.
And by the way, rating agent, you and I should have a word for the rating agencies. I was speaking at Wharton one time, and somebody said to me, "What is the role of the rating agencies in this process?" I said, well, the role of the rating agencies is to be wrong, because it gives us something to game against. I don't know how many people in this room know how many corporations are rated AAA today, but the answer is 4. How many mortgage obligations were rated AAA in the mortgage wave? Mike tells me 16,000. I believe him. So is it possible that after 100 years of economic history, our economy only created 4 AAA rated companies, but in a few years, Wall Street was able to create 16,000 AAA rated mortgage obligations? And it was probably the greatest opportunity to make money in a lifetime, in a short period. People say to me, what is my greatest regret? And I always say my greatest regret is that I wasn't John Paulson. But his little mutual fund made $16 billion that year on the mortgage trade.
Well, Howard, you had the chance to buy many bonds at 10 cents on the dollar.
This is true.
20 cents on the dollar that have already paid off at par. So,
yeah.
And in probably large volume. Let's talk about one of your favorite chapters in the book, knowing what you don't know. Okay, overestimating what you're capable of knowing and doing the extremely dangerous things rather than working within your limits. Why don't we talk about that?
Well, look, I think, Mike, and I know you agree, that the investment world is a world of excess testosterone, where people believe that they have to prove.
Well, we have women play a much larger role now.
Well, they may have it too.
Okay, good.
But people believe that it's their job to know what the future holds, that you can know what the future holds, that they do know what the future, or if they don't know what the future holds, that they have to act like they do, because if they admit they don't, they'll get bounced. And I believe that you can't know what the future holds. You can figure out which outcomes are the most likely and how likely they are, and what alternative outcomes are likely to happen and how likely they are, and which extreme outcomes could happen. And you can kind of sort the world into a probability distribution. And I think the best people in the world are the people who are best at visualizing that distribution of possibilities. But there's almost nothing in the world which is determined. Everything is uncertain. And Elroy Dimson, who's a professor at the London Business School, says that risk means more things can happen than will happen. There are very few things of which only one thing can happen. And yet people tend to invest under the assumption that they know what's going to happen. And I think that this is one of the biggest mistakes you can make. Mark Twain said, it's not what you don't know that gets you killed. It's what you know for certain that just ain't true. And I think this is very, very important. There's nothing wrong with saying, I don't know, and acting accordingly. And most people never get killed in that way. The real danger is in saying, I know, and acting on the assumption that it's correct, and then being wrong. If after this session, you and I are going to drive to Barstow, and
I could, but first I have to go to Africa.
Okay. Well, but if we say we don't know how to go, then we're going to get a map, use GPS, ask directions, and drive slowly to make sure we don't make a wrong turn. But if we assume we know, we don't get a map, and not just because we're men, and we don't ask directions, not just because we're men, we don't use the GPS, and we drive fast because we're confident. And if it turns out you didn't know, then you end up in Africa. So the point is, I think that it's very important to know what you don't know and to act accordingly and to respect what you don't know. And the point is, you don't have to know the future to be a good investor, and especially the macro future. Today there's a great belief that macro rules the markets. And so you should figure out when the Fed is going to let interest rates rise and stop stimulating, what's going to happen in Europe in terms of its staying together and how it bails out the peripheral countries, and how low China's growth rate goes. That these things are the things that are going to move the market, and so that's where you should spend your time. Now, the interesting conundrum is that in the short run, they are the things that are going to move the market, but I believe you can't know them. And if you can't know them, then you're wasting your time trying to know them, and you should know the knowable. And the knowable consists of getting an advantage versus other investors with regard to companies, industries, and securities. And these are the things where hard work and skill will pay off, and these are the things you should spend your time on.